Okay, got it.
Ladies and gentlemen, let me introduce a good friend of mine, Senate Eskridge. He is the man when it comes to creating funds. Not only has he been in part of 51 deals, raising capital, but also he's been exclusively doing real estate syndications and deals in his fund for the past several years. This is the man when it comes to creating your fund. He will tell you everything he knows. He's completely transparent. His values are there, and he's a heck of a nice guy, too. So, welcome, Senate Eskridge.
Oh, Chris, thank you so much for that introduction and everything that you do for me. I'm really excited for today. So let me share my screen and we will dive in here, friends. All right. Today is the fourth and final session of our four-part series here on launching a fund. I'm really excited. We've talked about a lot of stuff up to this point. The different legal requirements, brand identities, things of that nature. Today, we're going to talk about some financial engineering. How much money do you have to launch one of these funds? Um, what type of partnership models can you come up with? How much money can you make? And then I'm going to go through a 14-step launch plan for you. These are the steps that you need to do to launch a fund. And then at the very end, stay tuned to the very end, friends, because I have something really awesome to share with you towards the end. Okay, so I said to Gary and the rest of you a minute ago that there's a disclaimer. You guys, I'm not a lawyer. I'm not a CPA. I'm not a financial advisor. I'm just a guy that's done this a few times. And as Chris alluded to, so I'm giving you my opinion, my advice. None of this is legal or professional. You have to consult an attorney. That's required, by the way. If you're going to do a fund, I mean, I don't even think it's possible to do it yourself. I sure as hell wouldn't, even if it was. So get a lawyer. With that, one more, not a disclaimer, but a request, friends. I do a lot better when we're conversational. I do have a tendency sometimes to just start lecturing and going off on stuff. But if you guys have a question, please throw it in the chat and I'll try to get to it. And Chris is going to help me with that to make sure I get to them as we go. Or if you're brave, don't hesitate. Just unmute yourself. Let's talk about this, right? We are real people here. So let's have a conversation. All right, let's dive in and talk about how much does it cost to launch a fund? All right, so friends, we've talked before about how that there's two different types of these funds. You can go with what's called an SPV. That stands for single purpose vehicle or special purpose vehicle, right? I've heard both terminologies. But basically what this is it's a one capital raise, one investment inside one LLC with one PPM, with one set of blue sky filings. One and done, everything's condensed in one spot. You guys, there are huge advantages to doing it this way. There's also huge costs and huge disadvantages, right? So the cost to do one of these, depending on the vendor and how you set it up, you can see here is somewhere between $6,000 and $8,500 just to set one of these things up. And then again, depending on your vendor, with tax filings and annual filings and things of that nature, you're somewhere between $2,000 and $4,000 a year, right? Which again doesn't sound like a lot of money. But the challenge with SPVs is if you're going to raise for multiple deals a year, this can get very expensive very fast, right? So one of the first things you got to ask yourself is how many deals are you going to do a year? If it's one a year, maybe an SPV is the way to go. If it's more than two, three, four, five, something like that, I highly recommend you look over here to this multi-asset flexible fund. Some places call it a customizable fund. And there's a couple of different places you can go to get one of these, but the setup's going to be somewhere between $15,000 and $30,000. And annual maintenance, this is actually probably a little high, friends. Um, no, 10,000 a year. Yeah, about 10,000 a year for one of these. Okay, so again, if you're going to raise one or two times a year, an SPV is not a bad way to go. If you're going to do more than 2 a year, flexible funds definitely the way. Any questions on that? Does that make sense? Okay, excellent. So either way, whether you have an SPV or a flexible fund, how do you actually make money? What is the structure that you use to make money with these things? Well, you guys, I know of 4 different ways, and there might be more, but these are the 4 ways that I have used when I'm raising capital to actually make money with these things. So Gary said earlier, get a fund, and I believe the phrase was stuff it with a bunch of money. Yes, stuff it with a bunch of money, but then what are you going to do with the money and how are you going to make money with it? Okay. So let's walk through each of these. The first one, number one, equity class splits. You guys, I use this. This is the most common one that I use. Okay. Pretty simple, right? So the example here is, well, let's forget the example. Let's just say you go and find a big operator. Pick one that everybody knows. Rise 48. Okay, probably everyone on this call has heard that company. So Rise 48, if you take them $50,000, they're going to give you a 70-30 split and maybe a 7 pref on your money. But if you can take them at least 500,000, okay, they'll give you an 80-20 split and an 8 pref. And if you can bring them $1 million, they'll give you a 90-10 split and a 10 pref. And then what you do is you bring a bunch of investors in, 20 investors at 50,000, and you basically give them that same original 70-30 split that they would have gotten directly with Rise. Maybe sweeten the pot a little more. Give them a 75-25 split. But you keep it pretty close, and then you capture the spread between the two. Okay? This is what I do most of the time. Anybody have any questions about equity class splits? Okay, great. Number 2, again, the second most common one that I do. What this is a credit spread, okay? And the example here is about lending money. But what I do the most actually is not direct lending like this credit spread is talking about, but I still do it with other syndicators, okay? I have a debt fund that a couple people on this call have actually invested in. What it is it's a debt fund that pays investors 16% cash on their money. So somebody puts $100,000 into this thing, they get paid $1,333 a month. Well, because I'm raising $1 million for this investment, they actually pay me 19%. So this company pays me 19%. I take 3% off the top to keep my fund alive, and then I send 16% to the investors. Investors are happy, I'm happy, the fund manager's happy. Pretty simple, right? Great. You guys, that's the key to this. There's so many things when we're talking legal structures and SPVs and PPNs, all this stuff, that we as humans tend to make things super, super complicated. But really, if you just take a minute and simplify the plan, that it's very easy to understand, you'll go a lot further, a lot faster. All right, number 3. Again, because it's the third most popular thing on my list. I've done this a couple of times with my fund where you're actually joint venturing with the primary operator. And so the underlying deal is just an LLC. There's not a syndication or any of that kind of stuff. So what happens is the underlying asset creates an LLC for their entity, and they have their own operating agreement, all that kind of stuff. And there's 2-3 partners on there, right? Just like any other joint venture. One of the partners is your fund. Use your fund to raise all the capital, and then you deploy the capital into the joint venture, into the underlying asset. And then how does your fund make money? Again, it's about a spread, right? How much are you keeping versus how much you're paying your investors? But instead of going in as a syndication, you're a joint venture. That's a very unique thing. And if you're going to do that very often, you should really look at the 3C1 fund. I'm sorry, the 3C5 fund, not the 3C1 fund. We talked about that last week, right? The big difference between 3C1 and 3C5. 3C1 is primarily for people who are not operators or not joint venturing. 3C5 is for people that are joint venturing or operating. I feel like that should cause some questions. I'm going to pause for a second and take a drink. Any questions?
Yeah, I'm not seeing any right now, but I know that there's going to be some questions out there. So you can either raise your hand or type it in the chat or just unmute and ask it.
Cool. All right, number 4, the double promote. So basically, the short way to handle this is just charging a flat fee for money under management. So if you have $1 million in the account and you have a 5% fee, you charge them $50,000. Spread across all your investors. Did I do that math right? Yeah. Sometimes math in my head, got to double check. So these are the 4 partnership models I have used personally. I'm sure there are others. The thing is you can get creative and find lots of different ways to partner with underlying deals.
Hey, Senate, when you said the
Yes.
double promote, can you go more in details about that? That's kind of my first time seeing the double promote. I've seen the other 3 before.
Yeah. Great. Thank you for asking for that. So the easiest way to describe double promote, well, hold on. The reason it's called a double promote is because the underlying asset charges a promote percentage, the syndication. So the 70-30 split, right? The 70% the investors keep, the 30% that the underlying asset keeps, we call that a promote. Okay. And so what we're calling a double promote is if you're adding a promote fee on top of it. So the underlying asset has their promote fee, and then you're charging 5 to 10% over and above whatever those fees are. So it's basically you're charging an additional management fee. But this is just how you get paid. Like I said, it's pretty rare. There's lots of other ways to do it. And I've only actually done it on one deal, and I didn't like it. I don't know. Does that make sense, Kendall?
Yes, that did. Thanks.
Perfect. Thank you for asking. All right. So let's
Hey,
talk about
real quick, Senate,
Yeah.
can I ask a question? This is Kevin Wilson.
Yeah, Kevin.
What are there asset class preferences that you have for these different methodologies? Do you do only real estate?
Oh, good question, Kevin. Yeah. I love that. Thank you. Yeah, I'll tell you what I've done. So equity class splits. I do this when I'm going into syndications that are on the equity side, basically. So if I'm raising capital for Rise 48 or someone like that, this is also where I put in the businesses that I've raised capital for. So I've raised capital for paving companies, trash company. We're doing a bourbon distillery right now. But also this is where I put like the mobile home parks, the RV parks, all that kind of stuff. So anytime I'm in an equity position, I use number 1. Number 2 is when I'm in a debt position. So I've raised capital for 4 or 5 debt funds, and I just use that spread whenever I'm in when I'm in a debt fund. Or actually, no, debt fund's probably not the right term. Something that pays a consistent cash flow like debt. Right? So I do actually have one that is technically an equity play, but it pays its pref current, and it's a really high pref. So I treat it like a credit spread. Joint venture equity. When I'm the operator, that's the answer. When I buy my own deals, I do number 3. When I say I buy my own deals, I mean I have a partner that runs the asset, the actual asset manager, right? But I'm actually signing on the loans, technically, that kind of stuff. typically on number 3. And number 4, it was the only way I could make money on a deal, right? There wasn't enough spread. There wasn't enough equity for me to make any money. And it was a deal that a small group of investors specifically wanted to go into. And so I charged that double promote so that I could make some money. Great question, Kevin.
Thank you. Appreciate the insights.
Yeah, good. Happy to help. All right, let's run over to making some money, right? How much money are we going to make doing this? So break even math. The math on this slide, you guys, is using a 2% annual profit target. Okay. And again, you can build that in any one of these ways. Okay. But this is if you make 2% on the money under management. Now, just so you know, I target making 3%. But the way I come to that is I always take care of my investors first. So sometimes if it's a skinny deal, I might only make 1% even. And sometimes on a very rare occasion, I make 4%. But usually I target around 3% that I make. These numbers are based on 2 to under promise and over deliver. Okay. So pretty simple math. If you have $1.25 million under management, so you've raised this much capital from investors, and you're making 2% annual on that money, okay, you're going to make $25,000 a year. Well, if you go way back to the first slide that actually had content on it, we talked about how much it costs to open and manage one of these funds. So you're right about that $10,000 to $20,000 a year when you're in marketing and all that kind of stuff. So really this 1 to 1.25, maybe even 1.5 million, until you've raised that amount of money, you're just breaking even. And I want to make sure that we're pretty clear on that, right? This isn't a get rich quick scheme. This is building long-term relationships over time, building consistent, scalable cash flow. And I believe it's one of the highest paid things in the long run. Okay. Now, if you want to make $100,000 a year, all you have to do is raise 4.5 million. Okay. I'm sure those of you that are good at math, I know Chris probably has already caught the math on me. 4.5 million times 2% is only $90,000 a year. Well, you're also going to start eventually building in like profitability from these exits. And as you're building more income, you're going to make more money, right? And so we start to add in a 10% performance delta across all the assets in your life cycle, right? And eventually you're going to see that grow to about 20, maybe 25% over and above that. So how do you make more money, friends? Well, Gary, will you help me out? What'd you say you're going to do with your fund?
You just stuff it full of more money.
That's right. So you want to make more money? Stuff it full of more money. Pretty simple. Use 2% as your target, right? How much capital can you raise in a year? Multiply that by 2%, and that's about how much money you'll make the next year, right? Because you got to remember, if it takes you a full year to raise it, right, you're not making money that year. You'll make that money the next year. All right, you guys, we're getting down to some actionable takeaways here. So if you're a take a screenshot type of guy, the next 3-4 slides are probably the ones you want to take a screenshot of. So what tech stack do you need? How do you do this? Who are you going to call? Well, you guys, these the top companies are the ones that will help you set up your fund and also run your portal. Okay. If you're going to do a SPV, the one deal, one fund, I would call TribeVest. They're my friends, but they're the best in the community in this aspect of the business. They're the best. Okay. If you're going to go with a flexible fund, either one of these two will work. Cash flow portal, you guys, I know the owner, I know all of his employees. I have a cash flow portal account. They're amazing humans. Avestor, if you're new, these guys will walk you through. They'll hold your hand. They're pretty good, right? I wouldn't call it quite white glove, but they've got gloves, so they're nice. So again, portals and legal, that's up top, but you got to market, right? You got to reach out to these people that you're going to raise capital from. You're going to need one of these two tools, either active campaign or high level. Some people call this go high level, right? So pick one from the top and one from the bottom. And truthfully, your tech stack, besides a cell phone, pretty much everything you need right there. I feel like I'm going real fast. I literally have 4 slides left, and we've only been talking 25 minutes.
You're doing so good. Everyone's getting it all.
Good, Kevin. Thank you for that. Vote of confidence. All right, let's go through a 14-step launch plan. You guys, here are the 14 things that, in my opinion, you have to do to be able to launch one of these funds. The first thing you really need to work on, in my opinion, is your niche and your brand. Okay. Now, why is this first? Okay. The logo really doesn't have to be first, but the more niche you are and the more understanding of the type of investments you're going to do before you get this process started, the easier it's going to be. Remember, we talked when we did the legal conversation about the difference between a 3C1 fund and a 3C5 fund. And we talked about the difference between 506B and 506C. And all of these things are going to matter. Long before you ever talk to your portal, long before you ever talk to your attorney, you're going to be a lot better off if you can figure out what types of capital you're going to raise and from who and where you're going to put it. Okay. The next thing, your CRM and lead magnets. I want to talk a little bit about this, okay? Because the phrase lead magnets is probably daunting to some people, okay? My first CRM, you guys, literally was a Google Sheets, like an Excel sheet in Google. And all I did was put in their name, their phone number, their email address, and how I knew them. And I just made a list of like everybody I knew. That was my first CRM. And lead magnets, you guys, it doesn't have to be really fancy. It could literally just be your brand identity and what you're doing and why. But you've got to put a little bit of time into some of this in the beginning, right? Get your people together. Because I'm going to say something really hard here, guys. You've probably all heard the term your net worth is your network is your net worth, right? Well, if you do this step right here and you got 5 people on your list, you're going to have a hard time, right? Now, there's ways to market, there's ways to build a list from cold, all that kind of stuff. But these 2 things are really important, right? Because they help you figure out the why, they figure out the what, and the who you're going to go talk to. Those are probably the most important things in this business, you guys, and needs to be done before the legal, in my opinion. All right, steps 5 through 7, right? This is when you're reaching out to the attorney. And the attorney that you choose is very, very personal to you. And also there's some good ones out there and some bad ones out there, right? Some that are really, really rigid and black and white to the rules and say the government doesn't say you can do that, so you can't do that, right? And then there's some that are really easygoing and flexible and solution oriented. And they say things like, if you want to do that, here is the way you have to go about doing it, right? And so choosing that attorney is something that's very, very important. And it's out of scope for me today to make recommendations for you about attorneys, but I'd be happy to have a one-on-one conversation with you about that if you want some more opinions about the attorney. I already told you about the portals, right? Any one of those portals I showed you would be a fantastic one to use. This step right here, you guys, this is where the rubber really meets the road and where you're really doing the heavy lifting on the legal paperwork. And this is where you're going to spend some money, right? So if you go an SPV route, we already told you you're about $8,500. If you're going with a flexible fund, you're $25,000 right here in this step. Just so we're clear. Okay. All right. First 7 steps done.
Hey, Shannon, I do have a question. So
Great, Jamie.
how long is the process and how long does it take to go through your legal and your portal?
So Jamie, I love that you asked that question. I had 2 different conversations with people that help people set up these funds. And they said that steps 5 through 7 on average take 100 days. So 3 months. Hey, Jamie, I'm going to tell you a secret. That information is going to be really important in about 15 minutes. Great question. All right. So what do you do steps 8 through 14? Okay. So yes, your fund is being all set up and the lawyers are doing their stuff and you're answering questions for them and filling out forms. You need to also be working on launching the marketing side of your business, right? Steps 8 through 9 are when you go into your CRM and you build outreach sequences, right? And you build a plan to market to your warm contacts. And steps 10 through 12, right? You start building like email templates and text message templates and things of that nature to be able to reach out to these people. And you segregate your people based on how well you know them, right? Are they cold? This is somebody that's in my phone and I don't even remember who this person is, but I have their phone number. So I know them, but they're pretty cold. Warm is probably, hey, I met this person at a meetup a year ago. They might not remember me. And hot, maybe you consider these people, your neighbors, your people you go to church with, people you go to the gym with, your friends, your family, people that are really close to you, right? You're going to talk to these 3 different demographics a little bit differently. When I call my friend Max about an investment, I don't do all the little small talk, like super formal and spend 5 minutes warming up the call, right? Max and I talk 3 or 4 times a week, right? So that'd be weird. I say to Max, yo, I have this investment I got to tell you about. You got 5 minutes? But somebody that I've never talked to before, you got to take some time and warm those people up. Does that make sense? All right. And you guys, 13 through 14 is really just test and repeat and fix. But these are really the 14 things, right, that it takes to put one of these things together. And back to Jamie's question about how long, I mean, this is a 6-month business plan in 14 steps, you guys, if you do this on your own. All right. I want to give you some more actionable takeaways. I told you 4 slides for screenshots. This is a list of resources, places, things you can Google, right? These are actually live links, but I don't know how to get them to you. But the SEC has got a whole capital raising site about legal and compliance. They even have some ideas on how to raise capital. NASAA, this is more state information and helping you figure out your state's laws and your state's resources. But it is by the SEC. It's an SEC website. TribeVest, the company I mentioned to you earlier, they've got 100,000 resources on their website. I mean, it's just so many different things that they offer and information. Same thing with Cashflow Portal and Avestor, right? Avestor literally has a manual on how to run a fund on their support site. It's crazy. Anyway, 4 resources. And now, takeaways. You guys, hold on. Do not leave. I got more to tell you, but I want to talk about key takeaways here. We're going to pause for questions. Then I'm going to tell you about something really cool. All right, you guys, the takeaways here, you really need to think about your fund in the very beginning and what is the scale going to look like for you, okay? If you're just going to raise capital on one deal, one time, right? An SPV is the way to go, and you can really truncate all of this, right? Because it's one project. But if you're going to make a career out of this and you're going to raise on multiple deals, right? I'm up to 51 times I've raised capital. You really need to think about the scale and the long term. Okay. Second one is systems, you guys. The more systems you can build, SOPs, automations, systematize this business as much as you possibly can, because we've only been talking about the launch of the business. Actually running this business takes a lot of work, you guys. You don't just set this up and then it automatically gets stuffed with capital, Gary. You've got to stuff it, Gary, right? And then the last one is, you guys always have confidence. You've got to have a plan. You've got to have a system. You got to have experts you're working with. And if you don't have those kinds of things, you're not going to have good confidence. And you guys, confidence, in my opinion, is the #1 tool of a salesperson. All right. You guys, we've covered a lot in these 4 sessions. You guys have spent 4 hours with me. Okay, 3 hours, right? Because you don't always go the full hour. But hopefully you've learned all the things that you need to go out and do this, right? High level. What questions do you have? Anything left? Anything I missed in the chat? All 4 sessions, not just about what we talked about. Any questions at all?
Yeah, Senator, I do have a question. Since we got an expert in yourself on this call, I do got a question about like which one was your biggest hiccup? The 4 steps. Which 2, I should say, because it's 14, you said. So which 2 you kind of stumbled across, and not stumbled across, but it was like a speed bump and took you more time than usual?
Well, I'm going to be very, very transparent and honest with you, Kendall. I still have this same speed bump. Okay. 51 deals later. I've been doing this now. I've been raising capital since 2019, right? I still have it. And I have this roadblock, and maybe it's something I should work with my psychologist on. He's here, by the way, listening to this. I have a real hard time niching down. I'm stuck in my head, and I believe that if I only talk to one person, I'm ignoring everyone else. And every marketing genius in the world has told me the more niche you are, the more rich you are. This isn't a marketing presentation, right? I didn't claim to be an excellent marketer. I claim to know how to set this stuff up. But that is still my #1 sticking point.
Senate, I have the same exact issue. I've only been doing this, and I haven't done a fund yet, but the capital connection practice for about 2 years.
Yeah.
And I kind of jokingly tell people I only have 5 categories: data centers, commercial real estate, commodities, pre-IPO, secondaries, and then the 5th one is everything else.
Yeah. That's
That is a challenge.
It is. It is. But I've got a saying that I say in my family a lot. Like, if somebody tells you have a tail, you can probably ignore them, right? But if 2 people tell you have a tail, you might think twice. And by the time 3 people have told you have a tail, you might want to turn around and look, right? So I know that I should niche down. It's just not something that I've done yet. The second one was choosing my portal. I told you guys earlier, I have friends on both sides. I love Cashflow Portal. I love Avestor. And I had analysis paralysis for a month. It took me a month to make that decision. The other one I got stuck on a lot was, if you remember from last session, it was 2 sessions ago, we talked about the exempt reporting advisor rules and the 3C1 versus 3C5 decision. I paid extra money for my attorney, and we had probably 4 hours of conversations just about the difference between 3C1 and 3C5 and which one I should choose in my situation. Great questions. What other questions do you have? Nice. Anything in the chat? Let's see.
I don't see anything in the chat.
Okay.
Senate, could you talk a little bit about the management LLC that needs to be in place as well? I think that was referenced on one of your slides.
Yeah, for sure. So the LLCs are the number one protection for you, the fund manager, right? And so you're going to always, whenever you have one of these flexible funds, this doesn't necessarily apply to an SPV, but on the flexible fund, everyone I've ever seen has 2 LLCs. Okay. So the operating LLC or the fund LLC right here, this is the LLC that actually takes possession or that makes the investment into the underlying asset. This is also where you do all of the accounting for all the investors. Okay. And the accounting is something that you really got to have pretty much one of the portals I've told you about, because the accounting is very, very complex in a flexible fund. Okay. We talked about this before, but I'm going to reiterate it since you brought it up. That accounting, all of it's one LLC and all the money comes into one LLC, but then it has to be shifted to this investment for this investor and this investment for this investor, right? And you've got to really track all of that down. And then when it comes to tax season, right, the investors are going to get 1K1 from you. So, I've got one person on this call that's invested in 3 deals with me. And that person, I've got to be able to combine all 3 of their K1s and then send them 1K1 at the end. So it's pretty complicated on the account.
Hey, Senate, can I make a suggestion to everyone?
Please.
I'm a former CPA wealth manager. But when I was a CPA, one of the things that I figured out to tell my clients, when you're going to meet with one of your professional advisors, meet with them all. If you're going to meet with your attorney and you're talking about structure, you're talking about risk mitigation, you're talking about some tweak to your business plan, have your CPA in there, because there may be tax implications that the attorney doesn't know about. And you might even want your insurance person in there, or whatever different professionals you use, so they can all hear the same words coming from each other advisor in real time. And it's not you retelling the story about what they told you, because it will simplify things. And typically the only person that's going to charge you in that room is going to be the attorney. So it's not like you're adding costs by having your CPA or your insurance advisor or your personal wealth manager or estate planning person in the room. So please, whatever you do, if you're going to make any major decisions, have all your advisors in the room together or on a Zoom call, whatever.
Yeah, that's great
Thanks.
advice. Great advice, Kevin. Thank you for that. Great advice. I really like that. All right. I don't feel like I answered the last question fully, so I'm going to go back and make sure that I finish everything about the management LLC, right? So I was talking about the accounting, and all that's done in the operating LLC, but all of your profits, okay, have to flow up to the management level LLC, and then you take your profits out of that. This is just one more layer of protection for you right? So are we good on the management LLC and why you have to have that?
Say that over again there, Senate, please.
Yeah, so the operating LLC is where you take all of the ownership and all the investors get all of their profits, and all the accounting is done on that level. And then you as the owner, the manager, right? All of your profits get paid to the manager LLC. And then you take the money out of that, okay, to put it into your pocket. This provides more protection for you, more asset protection, and it makes the books cleaner. Good.
Senate, we've got a question in the chat here. Does it matter which state you register your fund?
Yes and no. So the context, that question is usually around like which state is most favorable from like an LLC requirement conversation. And from that conversation, all three of those states are really good ones to choose from, right? So setting up your LLC in Delaware is a really safe place. Texas is also safe. Wyoming is also safe. But what you really need to pay attention to is the exempt reporting advisor rules. So if you didn't get to see last week's session, I highly recommend you go back and rewatch last week's session where we talk a lot about exempt reporting advisor. And so the first thing you've got to decide again is you're going to do 3C1 versus 3C5, okay? And if you're going with a 3C1 fund, so if you're only going to be doing passive investments, you're never going to be an operator, you're never going to do the joint venture I talked about, right? You're only going to invest in other passive things. If that's the type of fund you're doing, a 3C1 fund, you actually have to pay really close attention to 4 different things: where you live, where your office is located, where you're actually literally doing the business from, what state your entity is registered in, and what state the majority of your clients are in. Because the exempt reporting advisor looks at all 4 of these things, right? Yeah, so go back and watch that if you haven't watched it yet. And I'd be happy to dive into more with you. All right. I want to share with you guys something really exciting. You ready to see a little bit different conversation? Okay.
Yes.
You guys, do you remember I just told Jamie a minute ago that it takes 100 days just to go through the legal stuff? Well, what if you could do all of this much, much faster? I would like to introduce you to the Money Mental Fund Lab. This, you guys, is, I'm going to say this is a cohort or a concierge of Chris and I holding your hand and walking you through everything you need to do to launch a fund. And we're going to do it in 8 weeks, friends. Literally hold your hand, walk you through every step that you need to have a legally compliant fund up and launched in 8 weeks. Okay. We're going to keep this to a very small group of people. 15 is our target. We're going to start September 1st. Doing individual syndications and doing this kind of stuff on your own can be very, very expensive, and you can make a lot of mistakes, and you can spend a month making a decision on what portal to go with. You can spend $2,500 trying to decide between 3C1 and 3C5, right? Like I did. Or you can work with somebody that's done it 51 times, and that's exactly what I intend to do, is really be your fund concierge. Okay. I'm not going to do any of this stuff for you, right? But I'm going to tell you exactly who to talk to, exactly what to do, hold your hand. And you know what? Even go to a meeting with you if you really need me to. Just like Kendall said, get all your people together on one call, right? That's basically what we're going to do. The Fund Lab, it does follow 3 phases, very similar to the 14 steps we talked about in the webinar I just did. It includes a lot of things. 3 hours a week with me, if you can handle that. right? We're going to spend 2 hours actually doing work together, where we're going to, this is going to be on a Tuesday afternoon. I think, I don't remember the exact time, but Tuesday afternoons, we're going to spend 2 hours together, literally putting your fund together, putting the documents together. We'll bring in guest speakers, the attorney that I plan to use, the portals we plan to use, the deal flow and due diligence that we plan to use, all of that kind of stuff when we're on those live sessions. We'll also have an hour that's literally ask me anything. Like, we could talk about your fund launch. We could talk about anything but politics, probably. You also get time with Chris, right? Chris is going to spend 60 minutes with each of you one-on-one, each person who joins this one-on-one, which that alone, my opinion, is easily worth $1,000, right? That one-on-one with him. He's absolutely changed my life. Plus, he's going to do trainings every 2 weeks inside the network. Okay. I'm going to have some documents and templates put together. You're going to get 14 months of access to Chris's Money Mental community, which is absolutely phenomenal, right? He threw that in as a bonus. He has so much content in there. A book club, personal development book club. He does sessions every Tuesday that are live, psychological teachings and how to help you become a better human. And tea time, which is, what do you call it? Kibitzing, right? It's just a group of people getting together and they talk about fun, personal development, and those types of things. You have ongoing calls with me and direct access to both Chris and I. Right. So those of you that are interested, there is a process, right? You literally can't just give us money. You have to apply to join this cohort. And then you have to have a fit call. Literally, you guys, this is almost like an interview. We've got to make sure that you're a good fit for us just as much as you've got to make sure that we're a good fit for you, right? The number one KPI for this is 100% launch of every member of their fund, right? So we've got to make sure that if you're coming to work with us, you're capable of doing that. And then we're going to build your fund, and then you're going to keep going, right? Number 4, stuff it with money, Gary. You also get access to Chris, as I mentioned earlier. This guy is absolute stud. He only works with real estate professionals, and he's a performance psychologist. The easiest way for me to describe to you how he's helped me is I truly believe that I have emotional wealth today, and I never did before I met him. That alone is well worth the price of entry, friends. All right, so we're going to do all this together, right? Groups of people, real people helping people. So if you want to apply, right, this is the site. I'm going to drop it in the chat so you guys all have it here. Or if you know a friend that wants to join, you can share that with them as well. And you know what, friends? People ask, what does it cost? We're going to do all this for only $7,500. Help you launch a fund in 8 weeks. And we have a 100% satisfaction guarantee. If you don't like it, I'll give you your money back.